Talk to the man upstairs, hoping he answer my prayers. Hollywood.
Feel like the jungle, lions and tigers and bears. Pray for me, 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 pray for me. What's up, everyone? Themeless Omega here, and that was the song of the day, Pray For Me by G-Eazy. Today I want to talk about the stock market. 3 things before I start. 1, the concepts that I'm going to cover are very simple. 2, this is in no way financial advice. And 3, I'm going to constantly refer back to my laptop so I can give you the concept correctly. I create this in like 45 minutes an hour, and I haven't had time to memorize the script. But you guys want the content, you asked for the content, you deserve the content, so I'm giving you the content. All right, let's begin. What is the stock market? A stock market, equity market, or share market is the aggregation of buyers and sellers of stocks which represent ownership claims on businesses. These may include securities listed on a public stock exchange, as well as stock that is only traded privately, such as shares of private companies which are sold to investors through equity crowdfunding platforms. Investment in the stock market is most often done via stock brokerages and electronic trading platforms. Investment is usually made with an investment strategy in mind. You can also invest in bonds. In finance, a bond is an instrument of indebtedness of the bond issuer to the holders. The most common types of bonds include municipal bonds and corporate bonds. There are a bunch of different factors that you have to take into account when you decide that you want to invest. 2 major factors, in my opinion, are risk and time. They have a direct relationship to one another, meaning that they move in the same direction. If one increases, so does the other, and vice versa. Now, particularly, I'm going to talk about age in regards to time. So it may seem as if age and risk have an inverse relationship, meaning that they move in opposite directions. If one increases, the other decreases, and vice versa, okay? But they still have a direct relationship, because even though age is going to increase and risk is going to decrease, as you get older, you have less time on this earth. So that's, in reality, the time's decreasing, right? So they're both going down. And to demonstrate this, if you have 2 individuals, they're both going to die at 75 years old, okay? One's 60 and one's 20. The individual who is 20 has a lot more time to recuperate any losses that they may have, so they're going to assume more risk as opposed to the individual who is 60, because they don't have as much time. So as you get older, you're going to want to become more conservative, because if something were to happen, you have time to recuperate, okay? Now, I'm going to talk about an example of a game show that'll lead us into the 2 emotions I want to talk about next that kind of rule the market, right? Let's say you were on a game show, and the game is really simple. You basically just have to call which side of the coin it's going to land on, right? Heads or tails. So each game you win money. If you lose all the money you've won up until that point. First game, you win, right? $10. Second game, $100. Third game, $1,000. Fourth, $10,000. Fifth, $100,000. Sixth, $1 million. Now, you can end at any time you want. When will you stop playing? There's no correct answer to this, okay? What this is supposed to demonstrate is that people are going to end at different times. You don't know that you're going to win until the 5th coin or 6th coin. You don't know that. You're playing as if you're going through the cycle in real life, and you don't know when you're going to end. And there's no correct answer. There are people who are going to be too fearful and end too early. There are going to be people who are too greedy and lose all the money that they've made up to that specific point. There are going to be people who are are right in the middle. And those people are going to exit at the right time. Now, sometimes it may just be luck. Other times it may be because you're informed, okay? So the 2 emotions that run the stock market, greed and fear. If you're too fearful, you're going to leave a lot of money on the table and not take advantage of opportunities that you normally would, okay? And that's also going to cause you to panic sell and leave from positions that you currently hold because you're scared of the outcome. So if we look at the 2008 financial crisis, when the stock market crashed, a lot of people lost a lot of money. And obviously the market was going down, so they were losing money in regards to that. But what I mean by like losing money is they took realized losses. So if the market just goes down, so like their shares were losing value, they were unrealized losses at that point. So they didn't become real, if that makes sense. So unrealized loss means that the asset that you hold depreciated, but you still own it. Now, when it becomes realized is when that asset, those shares decrease in value and I sell it for a loss. That's when it becomes realized, okay? Now, if these people would have kept those shares for a few more years, for the most part, they would have made their money back and more, a lot more. Now, there were definitely, the reason I say most part is because there were definitely companies that probably didn't rebound and probably went bankrupt. But the majority of companies rebounded from it, so the majority of people would have rebounded from it as well. The Dow Jones Industrial Average now is almost 3 times higher than it was in 2010. So they would have made their money back if they would have just held. But, as I mentioned before, that's where that being too fearful comes into play. Now, if you're too greedy, you're gonna overstay your welcome, and you're gonna lose money because you stood too long. So being too fearful or being too greedy, they're both bad. You want to find that balance. And that balance is really just informing yourself on these specific companies that you invest in so that you can make informed decisions. So when stuff happens, you stay rational and you can decide for yourself that you want to either buy, sell, or hold that specific asset. That leads me into diversifying your portfolio. So it's essentially saying that you don't want to put all of your eggs in one basket, all right? A sector is an area of the economy in which businesses share the same or related product or service. So with that in mind, would you want to put all of your money in a stock such as Apple, Microsoft, or Google, or a combination of all three? No, absolutely not. There's not a problem putting money into them. It's a problem putting all of your money into them because they all fall under the tech sector. Or even if it was just putting in the individual stock itself, it still wouldn't be good because you're putting all of your eggs in one basket, as I mentioned before. So the reason you don't want to do this is because if that sector were to take a hit, or that specific company, you're going to lose a good portion of your money. All right? And let's say, for instance, there's a country who implemented a law that affected that specific sector, that sector is going to take a huge hit. If you diversify your portfolio, when that sector takes a hit, the other sectors kind of offset that loss, or you're at least hoping for it to do that, okay? So ideally, you want to diversify your portfolio. There are a bunch of other sectors, which include energy, real estate, finance, and so much more. You have to look into that and see which specific sectors you want to get involved in, and you should do research on them and in the companies that you're investing in so that you can make informed decisions, as I mentioned before. You can purchase stocks individually, you can purchase bonds, ETFs, or mutual funds. There's a bunch of stuff you can do. Now, if you purchase individual stocks, that's essentially saying that you go and purchase a specific company. So if I go out and I purchase shares of Apple, I'm purchasing individual stocks, right? Individual shares of that company. A mutual fund is essentially a pool of money from many investors, and they are comprised of different stocks/bonds. ETFs are similar, and I'll talk about that in a little bit. Now, there are obviously advantages and disadvantages to each type. You have to decide for yourself what you want to do and figure out where that risk falls into what you're willing to take on. So mutual funds are professionally managed, so they're actively managed, and they require minimums. So the lowest mutual fund minimum that I've seen was $3,000, with the highest being $100,000. Okay? I don't know if there's lower, there may be. There's probably higher too. I don't know. But that's personally what I've seen. Now, ETFs are basically similar to mutual funds. They're basically the same thing. The only difference is they're passively managed and there is no minimum investment requirement, okay? So if I could buy an ETF based on whatever the price is for one share of ETF. For mutual funds, I have to put in the minimum requirement to even invest into it. So if the minimum requirement is $3,000, I have to put in an initial investment of $3,000, then I can put $5, $10, $100, and so on and so forth afterwards. Doesn't matter what amount I put in afterwards. So that's the big difference. And ETFs are passively managed. They're not actively managed. Mutual funds are good vehicles to put your money in like your 401k. I have them in my IRA. And 401k, if the company or organization that you work for provides a 401k, do it, especially if they match. It's smart, right? So some companies match up to a specific percentage. Let's say, for instance, my company matches up to 5%. Let's say 5% of my income is $300, okay? Or whatever I'm gonna make that month is $300. So if I put in the $300 and they match up to the $300, I'll have $600 in my account. Does that make sense? So I just basically made $300 free. It's free money. Why would I want to double my money for doing nothing? For just contributing money that I was going to contribute anyways. And it helps me out in the future in the long run, right? So that's always smart to do. If your company or organization contributes up to a certain percentage, contribute up to that specific percentage so you can get that free money. Okay, so for like the mutual funds and all that stuff, like in your IRA and 401k, you're not gonna touch that stuff for years until it's time for you to retire. But that's not a bad thing, it's a good thing because you're gonna make a lot of money in that time frame. Now, when you're following, like, I forgot to mention this, but for like the mutual funds and ETFs, there are different types of mutual funds and ETFs you could purchase. It's like, I have ETFs that deal with high dividend yield, and I have mutual funds that track the S&P 500. So it all depends on what you're trying to do. You will have to look at each specific mutual fund ETF to see if that's the risk you're willing to assume and if that's what you're looking for. But if you purchase these and you keep them in for however long you're keeping them in the market for, right, for your retirement account, it's going to average about 10% over a 10-year period, okay? So some years it might be negative, low single digits, 10%, a little bit higher than 10%, but on average, after those 10 years, it's going to be about 10%. It usually lands between 8 and 12, but if you average that, 10%, okay? Now, you'll make a good chunk of money. And a lot of people don't realize this, but you make your money on the compound interest, okay? Compound interest is the addition of interest to the principal sum of a loan or deposit, or in other words, interest on interest. So let's say, for instance, if I put in $100 today into the stock market, right? Or into a regular savings account, and I earn 10%, right? You're not gonna earn that on a savings account, but just for this example, I earn 10%. So I put $100 away, I don't add any additional money for the next 2 years, and I earn 10% for both of those years. At the end of year one, I'm going to have $110, okay? Because 10% of 100 is $10, all right? If you add those together, now I have $110. Now, at the end of year two, if I got 10% on the $110, that's $11. So if you add the $11 to $110, now I have $121, okay? And that's compound interest, essentially. You're just earning money on the interest that you've already earned, right? So interest on interest. You can test this out online on the compound interest calculator. I'll put the link to the actual compound interest calculator in the description below, so you can check that out for yourself. There's a quote that I think is really good when you're talking about compound interest, okay? It says to turn $100 into $110 is work. To turn $100 million into $110 million is inevitable. And that's by Edgar Rothman, all right? I don't know if that's how you pronounce his last name, but that's by that individual. And it's true, because if you have 100 million, to make that 110 million doesn't really take a lot. You just keep that in the market or whatever type of investments you have it in, and your money's gonna work for you and make you more money. Now, if you have $100, you don't have a lot of money working for you. So the more money you have working for you, the more money you will make. Okay, so the two examples that I want to give, they're going to have the same exact conditions. The only difference is one's going to start at 30 years old, the other individual is going to start at 20 years old. Now, they're both going to withdraw that money at 60 years old. Now, we're going to start off with the individual who is starting at 30. The current principal that they're putting in today is $20,000. The annual addition is zero, so they're never adding money to it again for the next 30 years. It's going to grow for 30 years, so 30 to 60 years old. And the interest rate is going to be 10% yearly over the time frame, right? So 10%. Compound interest is going to compound one time annually at the end of the compounding period. At the end of the 30 years, they're going to have a total of $348,988.05. That's a lot of money. Now, they put $20,000 of their own money into that, of their own principal, right? So in interest, they made $328,988.05. That's a lot of money that they made by having their money work for them. So that's not money that they worked for. Their money worked for that money over time. Okay? Smart. Now, think for yourself. Think to yourself for a second. What did the individual who put it in for an additional 10 years, who started at 20 and kept it in there to their 60, so for a total of 40 years as opposed to 30, what do you think their total number is? I'll give you a second to think about it. All right, so I'm going to tell you. Remember, same exact conditions. The only difference is they put it in for an additional 10 years. So at the end of those 40 years, the total value of that money is now $905,185.11. What they made in interest is $885,185.11. Huge difference for 10 more years. A huge difference. Time is money, literally. The more money you have, the more money you will make. So, rough swacking it, the difference in the interest in those 10 years that they made is about $557,000. That's a huge difference for 10 additional years. So the earlier you start, the better. So I'll actually have pictures, which I'm talking about it now, but it's already in the video because I'll have to edit it in. But you'll see the actual calculations. It's pretty solid. All right, remember, the earlier you start, the better. I do have 2 additional ideas now that I want to talk about. One being, what do you think about when you think about a millionaire? Like, what comes to mind? So I'm going to make a video on that in a few weeks, maybe next week or a week after, who knows. And then another one on budgeting. I think you guys will enjoy that. It's pretty cool. So hopefully you enjoyed the video. Leave a comment. Please subscribe, like the video. Also, give any other recommendation that you may have. I'll be more than willing to do content on it. It's fun. I enjoy doing it. See you guys next week. Ooh wee. Boo boo. All right, I'm gonna head out.
Yo.